Hello, I'm Elliott Gue, and I'm publisher and editor of Energy and Income Advisor, joining you today from beautiful Miami Beach, Florida, where Roger Conrad and I just finished a series of presentations for the Money Man's top-tier energy summit here at the Fontainebleau Hotel. So today I'm going to answer 5 questions I've received from readers over the past week. So let's get started. First question is from Nancy in San Francisco, California, and she just is asking what my short and long-term outlook is for crude oil prices. Well, Nancy, I think that we're going to see another leg lower in crude oil over the next 6 to 9 months. The reason being is that over the summer, crude oil prices were weak, even though gasoline demand was very, very, very strong this summer. This was a record strong summer driving season. The problem is that around October, November, and then again in the spring around March and April, demand for oil is very low. Demand for summer driving season is already over, and at the same time, we haven't gotten into the winter heating season yet. So we think that we're actually going to see another leg lower in oil prices in that time frame, in those periods of weak demand. I think oil could go to $30 a barrel or lower. But I do think we're getting close to a bottom in oil. And I actually think there's a lot of opportunities coming up on this next leg lower to pick up some really high quality energy stocks at what we call dream buy prices. So what we're looking to do, the opportunities we're looking to take advantage of, are picking up some high quality stocks at very good valuations on these periods of weakness for oil. So thank you very much for that question. So our next question is from Al in Trenton, New Jersey, and he asked, does the decline we've had in oil prices and commodity prices in general, does that mean the US economy is slipping into a recession? Actually, we think it's quite the opposite. I think what a lot of investors have wrong in this cycle, and the reason so many pundits have been so wrong trying to call a bottom in oil over the last year, is that they fail to recognize that this is not an oil demand-led cycle. This is an oil supply-led cycle. So it's not being caused by the lack of demand. In fact, global oil demand is growing this year in 2015 at the fastest pace in a decade. Next year, it's going to grow at almost as fast a pace as it did this year. So there's no problem on the demand side of the equation. We had a record summer driving season in the US. The problem is there's just too much oil supply out there. You've got OPEC producing flat out, and you've got the US still production not falling that fast, still up on a year-over-year basis. We need to see global oil production and global oil supply contract a little bit more before we're going to get upside in prices. So no, I don't think the fall in oil prices is a sign that the US economy is slipping into recession. In fact, I think it's quite the opposite. Remember, a lot more companies actually benefit from falling oil prices than benefit from rising oil prices. Obviously not great for some of the energy companies out there, though we see opportunities. However, we do think a lot of consumer-oriented companies are going to do extraordinarily well and be leaders of any rallies we see in the market. One example, one group to look at very closely is the restaurant stocks. You know, people have seen a huge boost to their income from falling oil prices. If they're not buying expensive gasoline, they're spending a little bit more on eating outside the home. And in fact, we're seeing a lot of restaurants reporting very strong growth in traffic through their locations, and that's been really powering profits. One name we like here, one of the biggest restaurant stocks in the country, Darden Restaurant, symbol DRI. So that's one we think is a buy on any dips you see in price, and will actually benefit a lot from lower oil prices. So thank you very much for that question. Our next question is from Michael in Albany, New York, and he asks, what about the refiners? In particular, what do you think about Valero Energy, symbol VLO? Actually, the refiners were a group that we really liked at the end of 2014 and in early 2015, but it's actually a group that we've moved away from, and we've advised our readers to take profits on a lot of the refiners, including Valero. And in fact, in our trading service, Pig versus Bear, we've been looking to play the refiners on the short side, actually betting on a decline in this group. And I know that's a little bit of an out of consensus view, but here's what the problem is. Refiners don't actually benefit from rising or falling oil prices. They actually benefit from the spread between the cost of oil, which is a cost center for them, they have to buy oil, and the value of the gasoline they sell. Their margins have been very high over the last 6 months because demand for gasoline has been so high in the US. So US refiners have been buying oil relatively cheap and selling gasoline to a market which wanted a lot more gasoline, so gasoline prices have been pretty robust. That's changing. We're coming out of summer driving season and demand for gasoline is going down, so are prices. Diesel prices and distillate prices have already been very low, and that's not good for the refiners either. We think there's more downside in the group. We say sell Valero, sell the refiners, take profits on them. Thank you very much for that question. So our next question is from Bill in Houston, Texas, and he's asking a very broad question, which is where are the best opportunities right now in the energy markets? And as I explained in reference to our first question, we think that oil prices are going to have another leg lower and then settle into a long-term range, which we call lower for longer. We think that's going to be between $40 and $60 a barrel. And we actually have seen this in the past. For example, back in the late 80s and throughout much of the 1990s, oil didn't do much. It was actually traded sort of flat, sideways, and several periods of extreme weakness in there. But some of the big energy companies actually did really well. Those companies that have the financial resources to go out and take advantage of distressed valuations in the energy markets, make acquisitions, did extremely well during this period of time. One company we like a lot is EOG Resources, and the symbol there is EOG. One of the biggest shale producers, operations in the Bakken Shale of North Dakota, the Permian Basin of West Texas, and their prime asset in the Eagle Ford Shale of southern Texas. They've really been doing a lot to reduce their costs and become more efficient in recent years. They can actually make as much money today at $55, $60 oil as they could in 2012 at $95 oil. They're actually making higher returns on some of their wells in the Eagle Ford Shale. They can actually make money even with oil prices down averaging around $50, $60 a barrel. So we're not looking to buy it right now. As I said, we're looking to take advantage of the volatility in the oil markets that will come over the next 6 or 9 months to buy it at a dream buy price. Our dream buy price on EOG is $63 a share. That's about the valuation it traded at the lows in 2002 and again in 2008. That's where you want to buy it. Buy EOG, but only if you can get it for around $63 a share. That's our dream buy price. Thank you very much for that question. Is from John in Miami, Florida, and he asks about what about Nordic American Tankers, symbol NAT. Well, Nordic American Tankers is a tanker company, a crude oil tanker company, and this is actually a really interesting market. This is one we actually think could do very well over the next year or two, and that's because just a few years ago there was a huge glut, a huge oversupply of tanker ships on the global market, and so rates were very unattractive. But what's happened over the last few years, because rates were so low, people were not building a lot of new tanker ships. Older ships have been scrapped, and this market's actually seeing an uptick in demand. And one of the main reasons for that is about 90% of the oil leaving the Persian Gulf travels on tanker ships. OPEC has been increasing production to boost their market share and try to squeeze a lot of these shale oil producers in the US and other non-OPEC producers out of the market. So greater market share for those Persian Gulf countries means more demand for tankers. So Nordic American Tankers is certainly one company that would benefit from that. Let me give you another one. This is actually not a crude oil tanker company, but a refined product tanker company. And we're actually seeing growth in refined products exceed demand for shipping of refined products exceed demand for shipping oil lately. And this company will really benefit from that. The symbol is CPLP. It actually has a 14% yield. Now it is very risky, it's a riskier, more aggressive recommendation, but they could really benefit from the uptick in demand for refined product transport. Thank you very much for that question.